Florida home builders confirm home equity is collapsing and your home equity is at risk. And according to Realtor.com, there are many who see the writing on the wall. According to a recent survey, 24% of homeowners are selling right now to lock in a profit. And 23% of homeowners are selling right now for family reasons. Unfortunately, it does not disclose what those family reasons are. But honestly, it's irrelevant because if selling is right for you, then selling is right for you. And while those figures are certainly eyebrow raising, they don't account for the other 57% who are also selling. And I know that does not necessarily mean that they are selling their home because they're being forced to, due to losing their job, death, disability, divorce, the skyrocketing cost of living, which is only getting worse, and mounting debt up to their eyeballs. But it might. And if you're feeling financial pain right now, then I don't suspect the trend is your friend, but I am. Hello friends, welcome back. You're watching Chris Igoe. If you find value, then please subscribe to the channel and give it a thumbs up. And be sure to hit the notification bell because I'm committed to sharing the truth about what's actually happening right now in today's market so that you can make the best decisions for yourself, for your family, and for your financial bottom line as it relates to buying, selling, or anything related to real estate. And if you've been watching for a while, you know that I have shared that when home builders slash prices, offer incentives, buy down interest rates aggressively, throw in upgrades, or pay for closing costs, offer real estate agents cash bonuses, or increased commissions, when they do those things, home builders are confirming what their supply and demand is, which is a major leading indicator as to what is likely going to happen next. Arizona and Texas home builders have been slashing home prices to move homes off their balance sheets for a while. And home builders in some Southwest Florida, North Florida, Central Florida, and Port St. Lucie, Florida housing markets have been slashing prices too. And while I've been keeping my finger on the pulse of the housing market here locally, I haven't seen it happen in my market yet. Up until I did. Devasta Homes in Palm Beach Gardens is the canary in the coal mine. And the home builder for Avondale at Avenir has been blowing up my phone for months with updates about their latest incentives. And truthfully, I did not pay much attention because the truth is those incentives weren't real. But as their inventory of homes sits and buyers who are on the hook, who are contractually obligated to purchase a home they built with the builder, choose to lose their entire deposit rather than purchase the home, which puts the builder in a bad financial position. And the incentives have changed big time as the builders get more and more desperate to offload their inventory. And no home builder wants debt on their books. As interest rates continue to skyrocket and the odds of being able to refinance their debt become a distant pipe dream. Back in March, Devasta got my attention because they offered up to $70,000 in savings on limited quick delivery or quick move-in homes. But then in April, they reduced the savings to $60K on selected homes. But bar the door Sally, this past Sunday, they offered me a $5,000 commission bonus. And they offered you, the potential buyer, $70,000 in savings for a limited time only. And that limited time wasn't very long because yesterday they increased the savings, or said differently, slashed the prices by up to $100,000 on new homes. I wonder what tomorrow will bring. And while it's factually true that Palm Beach Gardens is not Boca Raton, Delray Beach, or Boynton, which have yet to see any type of builder discounts, here's the crazy part. GL Homes is developing a new community directly next to Devasta. And the demand for that community in Apex at Avenir was so strong that they initiated a lottery and sold out completely, which is exactly what we've seen in Boca Raton at GL's other communities: Lotus, Lotus Palm, and Lotus Edge. But Port St. Lucie builders are slashing prices and praying it's not 2008 all over again. They don't want to get caught holding the bag. According to a new study put out by Florida Atlantic and Florida International University researchers, found the average home in this region is nearly 35% overvalued relative to its long-term pricing costs. And these researchers are sounding the alarm. And they are not alone. Redfin found that properties in Florida and Texas are stagnating on the market as demand is shifting away from those markets. And everyone knows that Redfin is never wrong. But don't tell that to the people who live in Cape Coral or in Northport, Florida, who just saw the country's biggest surge in homes for sale, with volumes up about 50% from a year ago in March. Meanwhile, South Florida home prices have continued to be on the uptick, and many folks feel these homes are extremely overvalued. But the market does not care about feelings, and the market is always right. But the trend is definitely not our friend, because housing markets across the state are showing slower price growth. Cape Coral posted a 0.63% decrease in home premiums, and Northport posted a 0.48% decline. Deltona showed a 0.32% decline. Lakeland, Florida dropped 0.07%. And the Tampa, Florida housing market isn't immune either. It showed a 0.04% decline. And the researchers who did this study at FAU and FIU went on to say that price growth should be tepid considering the slowdown in rents and rising interest rates, but South Florida prices continue to rise despite these market forces. And while these researchers certainly put together a very interesting research report, they aren't telling me anything I didn't already know. I've been talking about the liquidity crisis, which will destroy the housing market, for over a year. But right now, there are many folks who are completely priced out of the housing market. And it certainly doesn't help that Florida home insurance costs have skyrocketed, which is pushing down demand for some folks. But not everybody. There are still plenty of folks out there looking to buy now. In fact, I spoke to a cash buyer yesterday who's looking to relocate from New York. And he reached out because he wants to see a home in West Boynton Beach in the community of Canyon Lakes. And he did exactly what I would encourage you to do if buying a home now is right for you. He reached out to me. He gave me a call. And we quickly connected, and I let him know that this home is very likely to not be available. Even though it was still showing as active in the MLS, I had a very strong suspicion that it was likely this home was already under contract. Despite the fact that it was a relatively new listing, it was only on the market at that point for 3 days. And my hunch was confirmed after I spoke to the listing agent. They had received multiple competing offers, which bid the price for the home higher, and the seller had made a decision the purchase contract was executed, which is obviously great news for the seller. No bueno for my buyer. And yet inflation continues to ramp up. Economic conditions are worsening, and banks are about to get walloped by commercial real estate defaults at a magnitude of scale that we have not seen before. There will be a liquidity crisis, and banks will fail. Period. But don't take my word for it. Let's see what PBD and the home team thinks.
So why hundreds of U.S. banks may be at risk of failure. CNBC story. You could see some banks either fail or at least dipped below their minimum capital requirements. Christopher Wolf, managing director and head of North American banks at Fitch Ratings, told CNBC, consulting firms, Claris Group, analyzed about 4,000 U.S. banks, and here we go, found 282 banks faced the dual threat of commercial real estate loans and potential losses tied to higher interest rates. The majority of these banks are smaller lenders with less than $10 billion in assets. Most of these banks aren't solvent or even close to insolvent. They're just stressed, Brian Graham said. Co-founder and partner of Claris Group told CNBC. That means there will be fewer bank failures, but it doesn't mean that communities and customers don't get hurt by that stress. Tom?
So there is a crisis that's about to happen. And so he's saying, you heard what he said? There'll be fewer bank failures. What do you mean fewer bank failures? That's like saying, hey, when the hurricane just passes by, there'll be less rain, but it's still raining. Yeah. So that's what's going on. Here's a number for you. $962 billion of commercial paper refinancing in the next 18 months, ending around end of second quarter next year. So actually, we're coming up on a year.
12 months, yeah.
Yeah, it's 12 months out. I was thinking since the beginning of this year. $962 billion. Now, if the rates go down, that way they could refinance. Oh, wait a minute. The Fed just said the rates will be higher longer. Getting warm. So there may be fewer bank failures, but there's going to be bank failures. There's going to be commercial real estate that goes into receivership. And this isn't going to be like 1928 and the Great Depression, but you're going to see a ton of this stuff. And the big private equity firms and Jamie Dimon are ready for it because their balance sheets are ready to pounce.
And it's interesting that they use that term. They're not going to be insolvent. They're just stressed. So if you ever go to a doctor, they're going to do something called a stress test on you. They do the same thing for banks. Basically, how much money, how much cash reserves do you have in the house? Basically, the FDIC, what is it, $250,000 if you, anything above that. So I remember when you interviewed your buddy, your good buddy from WAMU.
The best interview ever.
Oh, yes.
The CEO. I actually enjoyed it. Yeah. He was upset. I was happy about it.
So we've seen
his wife was screaming in the hallway.
Yeah, so, I mean, what do you expect? But they couldn't pass the stress test. I think they lost, what, $300 billion?
They went from being a $330 billion company, WAMU, to Chase buying them for $1.9 billion.
Yeah. So that was the biggest bank failure, and that was obviously in 2008 because it was all tied to the mortgage. What was the term that they used for mortgage? Well, no income, no assets, but the toxic mortgage.
Also mark to market. The value of the assets dropped and suddenly...
But that was the biggest bank failure in American history. But all the other biggest bank failures we've ever seen in American history were in the last 12 months. Signature Bank, First Republic, Silicon Valley. I think First Republic had $200 billion insolvent. Silicon Valley, another $200 billion. Signature Bank, $100 billion. These banks better be ready to pass the stress test. The first time it was tied to mortgages, now it's tied to interest rates, correct?
And big commercial property.
Yep.
Yeah. He who has cash right now is in a nice place. He who has cash, you can buy a lot of things for a discount, especially now that inflation is not going lower. Mm-hmm. And by the way, Tom, if all of a sudden unemployment rates climb, just so everybody knows, this is the one thing that Jerome Powell is not going to know how to control. Can you go up to the unemployment rates right now, Rob? Just pull up unemployment rates in the States. Unemployment right now is what?
3.5%.
Is it 3.8%?
Find a chart for me. Find a chart.
Yeah, so right there, 3.8%.
Creeping back up is the bad thing.
Yeah, that's the thing. By the way, if that thing, you see it's not staying flat, it's kind of going up a little bit, right?
Yeah.
If that thing, Vinny, goes to 4%, 4.5%, if it goes to 4.5%, if it touches 5%, again, the key word is if. We can put another shirt.
Allegedly.
But allegedly, if it touches 4.5%,
what happens?
You know what happens?
What?
That guy named Jerome Powell has to change his position and actually announce rate increase of a quarter of a basis point to a half a point. Yes or no?
Correct.
Absolutely.
Yes.
If that thing touches 4.5,
And let's just say Pat, in the next couple of years, especially with AI taking over and a lot of these people are going to be jobless, that is going to start going up. That's the biggest fear.
Allegedly.
I'm just saying it is going to happen.
The number that they want to keep it under is 5%, correct? But if it goes to 4.5%,
not 4. I don't think it happens at 4.
5.
I think at 4, look, it's only 0.2 away, right?
Yeah,
It goes
no,
to 4.
5 is the number that they're trying to keep this bad boy
is
under.
the number. I think if it goes to 4.5, Jerome Powell's going to take a.
Pat, I'm itching for a bet. Because you're going to lose money to me. You're going to lose money to me. Do you think it gets to 5?
No.
Okay.
I don't think
by when?
I was going to take the under.
No.
By the election.
Oh, no.
And by the way, let's keep in mind.
No.
Just itching for a bet, guys.
No, I'm just saying AI is going to take a little while, but it's like you said.
You're right.
It's starting to creep up.
You're right.
Because what are those people going to, and then think about what's going to happen to society when all those people start losing jobs and they have no money.
Yeah.
Go think about that.
They're losing jobs now. The numbers behind the numbers on labor is scary. Q4, the net increase in jobs was part-time jobs. More full-time jobs were lost in Q4 than were created. It was a net decrease. The net jobs report in Q4 was part-time jobs. The net job increase in Q1 was part-time jobs. We have lost more full-time jobs than we've created going back to August of last year. So there is a shift that's going on in the labor base underneath, and that is the dirty little secret behind these jobs reports, which are politically driven. But the Fed, in all their footnotes, F-R-E-D, Federal Reserve Economic Data that comes out of St. Louis, they're putting it in the footnotes. It's there in the footnotes, but none of the mainstream media is talking about it. We're losing full-time jobs and replacing it with part-time jobs. McDonald's, as we said on the last podcast, had a tough earnings report and then warned everybody. And by the way, the full impact of $20 minimum wage in select market is going to hit me hard in Q2.
Tom, what was the Fred thing?
Federal Reserve Economic Data out of St. Louis. You can just look it up. It's called Fred. You go Fred data. And
Tom, let me tell you something. You're like Right Said Fred. Your stats are too sexy.
This is it. This is Fred. It's a public website by our federal government.
Yep.
And you would think that they would be hiding in it, but the footnotes are clear.
The unfortunate reality is nobody thinks it can happen to them up until it does. But when the economic or financial pain shit hits the fan, it will not be a slow and orderly unwind. When the market tanks, it will happen so fast, it will feel like your head is spinning. And right now, most people believe they are sitting on a metric shit ton of home equity because, in many instances, they are. Home equity is not real until it's realized. So if you're feeling financial pain or financial stress or financial terror, that selling your home is the only solution to cure, then please take action yesterday, because when you read about what happened in the market in the Wall Street Journal, it will be way too late to get involved. Everyone will be selling at the same time, and your metric shit ton of home equity will not exist. If you want to know your home's value, then please click the link up above or down below in the description, and we will send it to you right away. And keep in mind that the real estate market is always good for someone. It will always trade. And the market will always reward the smart, patient, prudent, opportunistic shoppers. And we continue to help people just like you find their dream home, find their dream lifestyle, negotiate the best deal possible, and max out South Florida living to the fullest every single day. But I suspect many folks who've been keeping up with the Joneses, racking up credit card debt, and not saving money are about to get wiped out. And there's no bailout coming because Uncle Sam is broke and hope is not a balance sheet item.